Let's go over the supplemental homework problems for Chapter 8. 8.1 says that AEH Incorporated just paid a $1 dividend, so we call that D0, dividend just paid, and is expected to pay $1.06 dividend next year. What is AEH's capital gains yield, which is also the dividend growth rate? Well, in this case, G is the percentage change or growth rate in the dividend. So if we expect $1.06 dividend in 1 year and it just paid $1 dividend, then we expect the dividend to grow by 6 cents. Thus, the dividend growth rate and the capital gains yield on the stock is 6%. 8.2 says XYZ Inc. stock sells for $50 and is expected to sell for $54.50 next year. Let's call that P1, and this $50 price is the price today, P0. What is XYZ's capital gains yield, which is the percentage change in the price? It's also the percentage change in the dividend. They are one in the same thing. So if the stock sells for $54.50 1 year from now, and it sells for $50 today, then the stock price is expected to go up by $4.50 on a $50 share price. So the $4.50 increase on the $50 share price is 9%, and that is the bond's growth rate or capital gains yield of 9%. 8.3 says PDQ Incorporated stock currently sells for $15 per share. The company is expected to pay a $1.50 dividend. So let me see, label this is the current price, P0. Is expected to pay a $1.50 dividend, that will be D1, and sell for $17.25 1 year from now, that is P1. What is PDQ's dividend yield? The dividend yield is the dividend you'll get 1 year from now divided by the current price you would pay to buy the stock. So if you buy the stock today, you'll pay the current market price of $15 and you'll get a $1.50 dividend 1 year from now. So the dividend yield is 10%. Part B says, what is PDQ's capital gains yield? That is the growth rate in the dividend. It's also the percentage change in the stock's price. So we'll calculate the percentage change in price, P1 minus P0 divided by P0. So the price will be $17.25. You could buy it today for $15. So I see the stock price going up by $2.25 on a $15 share price, and that is a 15% capital gains yield or growth rate in the price of the stock. Part C says, what is PDQ's total expected rate of return? The total return on a stock investment is the dividend yield plus the capital gains yield. So on this stock, in Part A, we got a dividend yield of 10%. In Part B, we got a capital gains yield of 15%. So if I buy this stock at its current market price, I would be expecting a 25% total rate of return on the stock. Problem 8.4 says AMB Incorporated's common stock is expected to pay a $2.60 dividend in the coming year. That is D1. If investors require a 14% return, that is your total return, RCS, return on common stock, 14%, and the growth rate in dividends is expected to be 9%, what is the price of the common stock? On common stock, the price today, P0, is D1 over R minus G. So on this stock, I already have D1, $2.60. I have R of 14 minus my growth rate G of 9%. So the price is $2.60 over 0.05 in the denominator there, or $52 per share. P0, price today. Problem 8.5 says a share of preferred stock pays a $2 annual dividend. It is priced at $40 per share, so what kind of required return are we looking at on this preferred stock? The return on preferred stock is the dividend over the price. The $2 dividend as a percentage of the $40 price I would have to pay to purchase the stock is 5%. If I pay $40 for the stock today, I get a $2 dividend every year. I'm earning 5% on my $40 investment. And 8.6 says, what is the price of preferred stock paying a $4 annual dividend if investors require a 14% return on their stock? The price of preferred stock is the dividend divided by the required return on the preferred stock. So I'll take that $4 annual dividend and divide by my 14% required rate of return. That gives me a price of $28.57 on that preferred stock. If I pay $28.57, I'm requiring a 14% return on that investment, and the $4 dividend does give me a 14% return on my $28.57 investment.